Good evening or possibly good afternoon to wherever you may be listening to us from today. I want to welcome everyone to our webinar on converting mortgage notes into cash flow. We have a special guest tonight who's going to join us and talk a little bit about investing in different types of notes and mortgages in a way to create extra cash flow. And of course, we're going to talk about that in the realm tonight of using your self-directed IRA account. My name is Scott Maurer. I'm the Director of Business Development with Advanta IRA. I'll be moderating the event tonight and can certainly help with any questions that anybody has as it pertains to self-directed IRAs, and I'll certainly be introducing our guest here in a minute. I want to remind everyone who is listening to the presentation live tonight that if you have questions, please type them into the chat box on your screen, and we'll make sure we get to them. Unfortunately, with the number of people on the webinar tonight, I can't take live questions, but you can certainly type in anything to the chat box that you have as we go forward. We are recording this webinar tonight, so if you're listening to the recording, my contact information is here on this slide, and we'll certainly have our guest give her information out as well as we move forward. Now, just a quick disclaimer regarding Advanta IRA. Again, my name is Scott Maurer. I'm the Director of Business Development for Advanta IRA, the self-directed IRA administrator. But before I get into what we do, I'll kind of tell you what we don't do. That's that we don't provide any legal, tax, or investment advice to any of our clients. We don't endorse any particular products or investments, and we're not affiliated with any other company, including the one that we're having join us tonight. We like to bring different companies and different individuals on to provide value and education, but we aren't affiliated with any particular other company. And so the material we're presenting tonight is for educational purposes. And if you do have questions from a tax or legal perspective, we would encourage you to talk to those individuals that you may know, or we can certainly provide referrals to an attorney or accountant or someone to help you out with your particular question. And just a background on Advanta IRA for those of you who are unfamiliar with us. We are a self-directed retirement plan administrator. We do have clients nationwide. We have an office in Tampa and one in Atlanta, where obviously a lot of our client base is located, but we do work with people all over the country. And we've been in the industry. Advanta IRA has been around for over 15 years now, serving the needs of people wanting to self-direct their retirement account. We do not do anything other than holding retirement accounts, whether it's an IRA or 401ks, and helping individuals invest that into alternative assets. We currently hold over $1 billion in assets between all the accounts that we hold, and we also have really a concierge-style customer service experience where each new account or each account that we have at Advanta is assigned to one particular person to work with the individual or individuals when they're making their investment. That's something I think is unique in our industry, and it gives a definite personal touch to those people who are looking to do something different with their retirement account. And we also pride ourselves on our educational offerings. Tonight's webinar included in that, and that we like to bring in different individuals, different topics, whether that be at one of our live seminars or lunch and learns or the webinar that you're listening to tonight. We want to not only inform you about what self-directed IRAs, but really bring in, again, guests and experts on the areas that are very peripheral to self-directed IRAs. So one of the things that we see a lot of individuals do with their retirement account from an investment standpoint is place that into mortgage loans. So that's why we brought in, again, our guest tonight to talk specifically about that issue. We do have an on-demand learning center online, and we certainly have a blog for you to take part of and get some more information as well. Now, for anyone who on the call who has not heard of a self-directed IRA before, maybe needs a quick refresher, essentially a self-directed IRA is a type of an account that allows you to invest in things that are under your control, things that you choose. Obviously, the term self-directed implies that, and it means that you're in control of choosing the specific investment that you want and not being pigeonholed or forced into an investment by a bank or a brokerage firm that's offering you kind of those limited investment products that they have. So a self-directed IRA is one in which you choose the actual investment, so long as it's allowed by the IRS, and choose ultimately what types of investments then make up your portfolio and how you allocate those funds as well. And the types of accounts that can be self-directed, any type of IRA, so whether it's a traditional or a Roth IRA account, a simple or a SEP IRA, also any old 401ks, 403bs, 457s, can be placed into a self-directed IRA account. So self-directed really refers to the ability that you have to use your retirement funds to invest in things like rental properties and rehabs and private notes and mortgages that we're going to talk about tonight, gold and silver, a lot of different things that you can do with your IRA. There's a lot of private placements and private stock out there that our clients invest into. But you have to have a custodian that's willing to do it, and that's really what, again, the term self-directed means. It's not necessarily a type of IRA that the IRS recognizes, because the IRS recognizes the traditional, the Roth, the SEPs, and the simples that you see on this particular screen. Self-directed, again, is your ability to place those funds in those accounts into the investments that you choose. And if you do have maybe a conventional IRA or a 401k with a bank or a brokerage firm, it's fairly easy to get that money moved over. It's usually done by either doing a transfer or a rollover. It just depends on the nomenclature, depends really on the type of an account you have at your other firm, but we certainly can help you out with that. But it's a tax-free movement of money. When you're going from IRA to IRA, or you're rolling over a 401k into a traditional IRA, no tax consequences. The money moves right over, and then from there, you're able to choose in obviously what you want to invest in. And doing transfers and rollovers are unlimited. So if you have multiple IRAs, you can move multiple IRAs into one account. You can move money back and forth between different IRAs as often as you'd like. You do have a lot of flexibility. And importantly as well, earnings within an IRA account. So we'll talk today. I know that our guest is going to share a case study, and I'll go through a case study of my own at the end using an IRA. The earnings coming back into an IRA account are also unlimited. So the IRS places no restriction on how much you can make and gain within your particular IRA account. Now we're going to talk about private lending today with our guest, who I'm going to introduce here momentarily. But when it comes to private lending and making an investment in your IRA into a mortgage loan or into a promissory note, there's a lot of different types of private loans that are out there. There's your traditional mortgage loans. There's shorter-term transactional funding. People doing unsecured promissory notes where you don't have a piece of property backing your particular loan. Individuals investing in equity participation ventures, and even individuals securing their notes with farm equipment, automobiles, livestock, other assets than real estate to act as security for their private loans. So you can get very diverse in what you're doing, even in the realm of private lending. So we will talk a lot of times about self-direction being so open, and there's so many different investments you can make. The great part is as you dive into each individual investment, there are a lot more options within each individual particular type of an investment, and private lending is no different. As you can see, of all the different loan types that are out there, and then when you get into each individual loan type, you get the terms of each individual note. Whether you are doing an unsecured note or a traditional mortgage loan, there are a lot of factors that go into obviously setting your interest rate, setting your maturity date, setting your equity participation if there is any. And so all those different factors go into the particular self-directed IRA investment, and especially, again, when it comes to private lending. Again, there's just a lot of benefits. Again, what we've heard over the years, people like the fact that mortgage loans have less liability sometimes than owning real estate directly. And you get to act as a bank and determine your own terms if you're actually originating that particular loan. And then, in fact, can be a very low maintenance asset, one in which you are making that loan from your IRA account. Each month you're getting the return of cash back into your IRA, that cash flow kicking it back in. And then from there, you just watch that money pile back into your retirement account. So at this time, I'm going to bring in our guest. We have Patty Ped with us today, who is the CEO or Chief Operating Officer of Ader Financials, that deals a lot in buying notes. They do a lot of first and second position residential notes that are secured by real estate, a lot of times specializing in non-performing notes and distressed mortgages. And Patty's going to share a lot of information tonight. Some of it just kind of get a basic understanding and then ramp up to really talking about getting cash flow into your IRA account. So, Patty, I'm going to turn the presentation over to you. If you want to go ahead and click to share your screen, get moving forward, we'll get on to your portion of the presentation.
Great. Thank you for having me, Scott. Good evening, everybody. Can we start the webinar with a quick poll, Scott, if you don't mind?
Sure.
So show of hands. I know there's a raise hand option there. How many of you have heard of mortgage notes before? Wow, I see quite a few. That's nice. And
Mm-hmm.
how many of you have actually invested in mortgage notes before?
Yep. So if you can raise and lower your hand using the control, and if you can't speak, if Patty, if somebody asks if you need to speak up just a little bit.
Oh, okay. Let me see. Is this a little better?
Yep, that sounds great.
All right, great. Awesome. So it looks like some of you have invested in mortgage notes. So hopefully this webinar will still be educational for you. And for others, I've tried to make this a very informational and educational webinar where we delve into the world of notes and, just cover the basics, what they are, what type of notes exist, which one is the right one for you based on what you want out of your investment, be it cash flow, high yield, equity, or whatnot. So let's dive in. I'm going to share my monitor. Please let me know. Scott, can you see
Yep,
what I'm
that's up
sharing?
front and center. Yep, perfect.
Okay.
Yep, your title slide.
Awesome. Okay, great. And those of you who've attended our previous webinars before, thank you so much, and that are on our email list too, thank you. If you're not on the list, we do monthly or biweekly webinars, and many of them with Advanta IRA. And if you sign up for our email list or just shoot me a quick email at the end of the presentation today, I can send that information over to you. Okay, let's get started. So just a quick disclaimer, this material that we're talking about today is for informational purposes only. This is not an offer to sell or solicit any offers to buy a security interest or anything else. If you want to invest in this, you should contact your attorney to obtain advice with respect to any particular financial issue or problem. That being out of the way, a quick little background about Adair Financials. We are a nationwide private mortgage investment company. We primarily invest in distressed residential mortgage notes, and we are going to go over that very quickly. We work with investors, banks, realtors, and we have a power team in each of these states that we work in. And what we do is we try to create win-win situations for everybody that's involved in the process, the bank, the joint venture partners, and not to forget the property owners who are actually a key component of this entire process. In this presentation, we're going to go over what mortgage notes are, what type of notes exist, and based on what you need out of mortgage notes, what type of notes that you should be investing in, and what kind of cash flows that you would typically see in mortgage notes. I'm going to present a couple of case studies so you know what kind of costs go into it and what kind of ROIs you typically see in these kind of situations. And then we'll also have time for questions, and as Scott mentioned, if you have any questions during the presentation also, feel free to just type them into the chat box, and Scott will be able to give them to me, and I'll probably try to answer them during the presentation. So most of us here are very familiar with mortgage. We know what a mortgage is. It is a loan that is secured by a property or real estate. When we go to a bank, when we want to purchase a property, we approach the bank, and then the bank would, if our application gets approved, the bank would then issue a mortgage on the property, and then the second part of this deal is called a note. The note itself is a promise to repay a loan. So when we talk about notes, we're talking about the mortgage and the note, which are two separate documents that you receive with your approval of the mortgage on a property itself. So when a borrower receives a mortgage from a bank, every month they make payments to the bank. So when the borrower is making regular monthly payments, we call that a performing mortgage. And this goes on for a few months or few weeks, and then due to some kind of situations like the 2008 market crisis, or maybe the borrower lost his job, or there's a death in the family, there may be multiple reasons why borrowers may sometimes default on their payments. So when the borrowers stop making monthly mortgage payments to the bank, it is now called a non-performing note. And at this stage, the bank wants to cut their losses because they are not receiving. The bank makes money by the interest payments that they receive on the monthly mortgage payments. So every time the borrower makes a monthly payment, a portion of it goes into the principal, and a major portion of it, at least in the initial years, goes into the interest payment. So when the bank stops receiving these mortgage payments, it is under a huge loss. Now, what can a bank do in this kind of situation? They want to cut their losses and they want to move on. So in order to do that, that's where we come in. As an investor, we would now try to help the bank out in such a situation. We would buy this non-performing note from the bank at a huge discount. And why is this bank selling us for a huge discount? Because it can no longer pursue the borrower. Well, some of the banks do have separate workout departments, but most of the major banks do not have the energies, and they want to keep their records clean. They do not want to go after these borrowers, file foreclosures on them, and they don't have a specialized team that could provide unique solutions or creative solutions to the borrowers and help them, try to help start making payments again. So now the bank would sell these at a huge discount to an investor. It may be an institutional investor or an individual investor. And that way they can charge off these loans on their account and maintain clean records. Now, us as investors, we go in and we purchase these loans from the banks. And then the investor would help the borrower start making payments again. We would initially contact the borrower. There are very certain rules that we need to follow in order to do this step. There are CFPB rules, and there are multiple other things that we need to keep in mind when we do this. So when we approach the borrower, initially they are notified that the loan has been bought by us, the new company. So a letter goes out from the old bank that their loan has been sold to Ader Financials. And then a letter goes out, a hello letter goes out from Ader Financials saying that, hi, we're your new loan lender from now on. Here's where you send in your payments. Here's how you can contact us. And all of that information goes to them. And sometimes the borrowers, as soon as they see that new lender information, they call in to make sure that it is legal and they have all the correct information, and then they can send in their payments. Sometimes it requires a little bit of help from our end so that they can actually figure out their financial situations. Sometimes they may have some other money stacked up in or stuck in some other situation that we may be able to help readjust their finances a little bit. And we can provide multiple strategies for them. We can provide repayment plans for them. We can sometimes reduce the amount of monthly payments for them, or there's multiple things that we could do that the big banks cannot afford to do, or the rules do not let them do, that the borrowers like when they work with us. So when we provide those kind of payment options to the borrower, we are helping them stay in their homes. Our main focus is to help the borrower so that they can continue to live in their homes and they can start making their monthly payments again. So we help the borrowers, and when they start making their payments, according to our amortization table, we go back and apply those payments to the loan, and that's how that would help create or build back their credit for the borrowers. So this now becomes.
I have a quick question.
Sure.
What do you think right now? I mean, obviously we've been through different times with, the mortgage crisis of several years ago now, I guess a decade now. But what are the reasons you see now people are most often defaulting on a loan? Is it a job? Is it, or losing a job, or, just curious, what are the primary reasons you see people defaulting on loans now? Because in general, I think the economy's been improving, but obviously there's still a business for buying non-performing notes, and obviously people are still defaulting. So just if you can, maybe just share with us what the primary reasons are where you're seeing defaults now.
Yeah, absolutely. So you're right in saying that the situation has definitely become better than it was, say, in 2008. But I think from what we see, most of them are still trying to find suitable employment, and also sometimes it's disability in the family, sometimes there's a death in the family, sometimes the main breadwinner, sometimes it's a divorce. So there's multiple reasons that we're seeing, and again, each situation is completely different, so it's not like we have a cookie-cutter solution for the borrowers. Depending on what they're going through at that point of time and how their finances have been during the past few years, we try to sit down with them, and they send us some documentation as to what kind of help they're looking for, and we try to work with them on that. So yeah, but the reasons we see are all over the place, really. I couldn't say it's mostly because of the economy, but it certainly plays a major role in that as well.
Okay, that's great. Thanks. You can continue on. I just encourage anyone who's listening, again, if you have questions for Patty or myself, please make sure you get them into the chat box.
Great. So quick recap about the life cycle of a note that we just talked about. So this is when the note is originated by the big banks, and as long as they are receiving monthly payments, and they do sell performing notes also, though not quite as often, but I will be going into that later in my later slides. But as long as the bank is receiving regular monthly payments, it's considered a performing loan. And at the end of the term of the loan, the borrower could either pay off the loan or they could refinance. In case they stop making any payments, then it becomes a non-performing note, and which is then either sold off to another investor, in which case we, the investors, become the bank, or the bank has their own team that can work on this. So the options for non-performing notes are some of the options that I've listed here. Of course, I can't list all of them because they're, again, very customized to each borrower, but we could offer a loan modification for them, which would, again, put them back on the path to either doing a payoff or refinance at the end of the term, which is then known as a reperforming note. Or we could, if the borrower does not wish to stay in their home, we could do a short sale or a payoff. And if we sometimes run across a non-responsive borrower, we initiate foreclosure on them if we are unable to reach the borrower, or there may be several reasons why we would want to initiate foreclosure on them. And in those cases, again, it may end up becoming an REO, which is a real estate-owned property, or during the course of foreclosure, the borrower may come back and say that they want to do a loan modification and they want to work with us. So that, again, becomes a reperforming note. So there's several exit strategies that we could consider with a note once we purchase it. coming to
Yeah,
the
Patty, I did have a great question come in, I think, while you're on this topic. Someone asked, when AIDR purchases a note from a bank, do you get to hand pick which notes that you purchase and then apply your own underwriting criteria? And then maybe give a few examples of what your underwriting criteria is, for example, DTI, FICO, verifiable income, et cetera. I don't know if how much you can share of that question.
Yeah, no, that's a great question, actually. I'm glad you asked that. So yes, it depends on the bank that's selling these loans. Sometimes the banks allow you to cherry pick, which it's called cherry picking, when they let you choose which ones you want to buy. But most of the times it's an entire pool of, say, 100 loans or 200 loans, and it's a mixed version. Sometimes there's some really good loans in there that can give you a good ROI, and sometimes there are some bad ones which, well, I take that back, sorry. So in our situation, there are no, I wouldn't call them bad loans. It's just how you structure the loan. So it's a mix. So when you end up buying a pool, it's a mixture of these things. And sometimes banks do let you cherry pick. Like the one in Utah that we bought recently, they had 2 loans that they were trying to sell, but we only liked one of them. So that's what we bid on, and we won the bid. So that's what we bought. So yes, we can do both ways. And when we are trying to pick and choose, we have our own criteria that we use. We try to, since our focus, AIDR Financial's focus, is basically to make them reperforming notes, we try to choose properties that are owner occupied, to make sure that the owner is still living in there and they have some emotional equity in there. They are certainly interested in keeping their homes, and if they've tried to, and we look at the pay histories, the servicing history, we try and see if they've ever contacted their previous lender before, if they've actually tried to have conversations with the lender before, and what their intent is with the home. Also, we try to make sure that we do all of our due diligence to make sure that the property is in a good location. So we have our realtors in that area do a quick drive-by for us, where they report back to us about the property condition, what the estimated repairs are, and what the ARV cost, the ARV is, and what the repair costs are. So all of those things, what the rents are like in the area. So we have a lot of things that we look into before we make a decision on the loan. I hope that answered your question.
Yeah, no, I think that covered a lot of it. So go ahead and, yep, in fact, I said a great answer. So go ahead and continue on.
Okay, perfect. So let's talk about the types of notes that we have, which is, again, just what we looked into, but this is going to be a little more in detail. So the performing notes are basically what you get when the bank, or in this case you, whenever I say bank, it could be just you, because in this scenario, when an investor purchases the note from the big banks, then you become the bank yourself. So when a borrower starts making monthly payments to you, that's when the note is a performing note. Now, when you want to purchase this from the bank, the typical discount that you see on this would be very less, because it's an actual cash flow producing note. So you would see discounts from 5 to 10%. When I say discount, for example, if the unpaid principal balance on the loan is, say, $100,000, if there is a 10% discount on the loan when you're purchasing it, that means the bank is willing to sell you that loan for $90,000. And the cash-on-cash yield for such loans, especially because you're buying it at a high price of 90% of the value, the unpaid principal balance is typically 7 to 6%. The characteristics of it is that you have regular monthly cash flow. Every month, on say the first day of the month, you have money coming into your bank account directly. Many a times the lender set up automatic payments, ACH, and then the money directly comes into your account every month. But the default rate on this is very, very low because it is a performing note and the borrower has been paying consistently for the past few years. So when you want to review or perform your due diligence on this, you need to look into the borrower's payment history to see how many days delinquent the borrower has been, how many times they've been delinquent, and what kind of situation they're in. So there's a lot of due diligence that needs to go in there, so you can ensure that the default rate is up to a minimum. So the next kind of note is a sub-performing note, which is a loan which is, say, more than 3 months delinquent at one point, and then the next month the borrower pays 2 more months of payments, and then a month goes by and then they don't make their payment. So it's very irregular. It's not, there's no specific pattern to it, but if you see that a loan has been consistently delinquent, then it's called a sub-performing note. And there's usually a higher discount on these type of loans than it would be for a performing loan, which is about 20 to 35% of the unpaid principal balance. So if you see a note, a note which has an unpaid principal balance of $100,000, you would see you may be able to purchase it from the bank at, say, $65,000, and this is again the highest discount that you could get, but that's typically the range that you would see in there. The yield on this, again, since you're buying it at such a low price, the yield is a little bit higher. It's 11 to 14% on it. There is cash flow on this, but it's going to be irregular cash flow. You cannot expect it to come in every month. There is a better equity protection in here because the property itself is providing collateral for your loan. If the borrower is based on how your note is structured, if the borrower defaults for more than, say, 5 months or 6 months or whatever is written in the contract, you have an option to foreclose on the property itself, and that's what's keeping it as a collateral for the loan itself. So there's better equity protection here. And again, that's the same case with performing also, but you won't see that happen that often in there. So that's what a sub-performing loan is. Now coming to a non-performing note, anything that's more than 90 days delinquent is called a non-performing note. Again, some banks have different specifications as to what they call non-performing or non-accrual loans or charge-off loans, but typically if it's more than 90 days delinquent, you would call it a non-performing one. And there is usually a much higher discount on a non-performing note only because there is some risk involved in it. As you see, as you keep going from a performing to a sub-performing to a non-performing, the discounts are increasing because the risk is increasing, but the profits are also increasing along with that. So it is high maintenance to have a non-performing loan. You need to have a good team that you could work with, a servicer. You need to have a good attorney. You need to have some realtors who could drive by and get you the information on the property. So it's good to have a great team that could work for you to ensure that your money is sufficiently insured in the asset. So the yield you can expect from this are potentially 15 to 30%. You could get very high yields because in case the borrower wants to reinstate their loan, you would get a lump sum amount in the beginning of the loan, or whenever from the beginning of the time when you become the lender on the loan. Or in case the borrower, say, has another IRA account, or they've just received a 401k account, so they can dip into some of those savings, and they may want to reinstate this loan in order to keep their home. So all of these could potentially provide high yields for you, and that's one of the reasons it's actually a high touch and high maintenance type of loan. Now the other thing is reperforming. Once the investor talks to the borrower, the negotiations are done, we've figured out a way to help the borrower, and now they're happy making their payments. If they make 12 payments in a row every month, then that's called a seasoned loan, and it becomes a reperforming loan at this point. Now, a reperforming is, in terms of discount, it's in the middle between a performing and a subperforming loan, only because we know that the borrower has defaulted in the past, so there's a higher chance or a higher risk involved here. But still, since they are making payments every month, it shows that the borrower intends to live in the property and wants to keep the home, so they're willing to work with you on the solution. So that makes it a really good investment in terms of cash flow and the discount. The only thing that I would say is if you need to make sure that the discount is enough so it can provide you downside protection. Very briefly, first and second mortgages, they're both loans on the property that the borrower has taken with the house as the collateral. So the first lien, whenever there is a foreclosure, the first lien takes precedence, barring some tax liens, municipal liens, HOA liens in some states and other things. But in terms of mortgages, first lien definitely takes precedence, so you get paid off first. And then the junior liens, which would be the second, third, fourth liens, get paid after. So we work, as I was mentioning, so we work with our investors so we could provide very high returns for them, and then we try to provide unique solutions for the homeowners so they can get back and keep their home and get back in on the horse. And we try to help liquidate the non-performing assets for the bank and help them as well. So let's go over quickly a case study. This was a second mortgage that we purchased for $7,000. It was in Connecticut, and there's actually a date on the picture, if you see, was back in May 2017. We spent $7,000 to purchase the lot, and this was a second mortgage. The fair market value at the time was $240,000, and the unpaid principal balance, which is the UPB, was $17,000. It was a big house with 6 beds and 3.5 baths and almost 3,500 square feet. It was owner-occupied. When we did our due diligence, we did find out that it was owner-occupied. And then we performed skip tracing on them. We got their current phone number. We tried to reach the borrower multiple times, and we made successful right-party contact. Initially, the borrower was unwilling to talk. They were considering bankruptcy at the time. They wanted to they had actually approached an attorney to file for bankruptcy, but we spoke to them and we were able to guide them through their financial situation. And the previous lender had actually filed a lis pendens, which is the initiation of foreclosure on the property, and we added our name as a substitution in the court. And then after all of the negotiations happened, we helped the borrower. We looked at their financial situation. The borrower was able to reinstate the full loan amount to us, which was at the time $13,500. And then after that, they were regularly sending us the monthly payments of $250 every single month since then. And then we released the lis pendens on their name, which means that we closed the foreclosure. We did not want to pursue that anymore. And actually, we received a call a few days ago on April 10th asking for a payoff on the loan. The borrower just wanted to pay off their entire loan. And so if we look at the numbers here, for the first year, total expenses, including what we spent on the lawyer, holding costs, what we spent on the servicer, the realtor, the appraisal, and all of those came up to $9,000. Our total profits from the first year alone, 2017, was $5,500. And then the ROI was $61,000. I'm sorry, 61%. But I still need to do the ROI on this one, I guess. So the payoff that we received in 2018 was $11,000. I think the check was just dispersed a couple of days ago. I think it was on Friday or Monday, if I'm not wrong. So the total ROI for this entire deal was 173%. And this was one of our home runs, I should say. I'm not saying that all our loans are going to be like this, but this is one of the loans that we had a really good rapport with the borrower, and we were able to work out something that worked out for all of us here.
Hey, Patty, we had a question just come in. Somebody was asking, though, in that last example, what was the size of the first mortgage? So you said you were buying the second mortgage. How big was the first mortgage position?
The first was, I think the UPB on that was $140,000.
Okay, so there's still a lot of equity in that property.
Yes, absolutely. There was a lot of equity in there, which is why the borrowers did not want to let go of the property, and they were considering bankruptcy. But luckily, we were able to, go through all of those details with them. We kind of explained the situation as to how it would negatively affect their credit score and everything. So luckily, we were able to, work out with them and come to a win-win situation for everybody involved.
Okay, and we actually had a couple other questions came in, I think probably more about the process to involve. If I can throw these in there. One was, how do you protect the collateral if the homeowner defaults on the insurance for the house? So I assume, how do you make sure that the insurance is being paid by the homeowner?
So that's a great question, actually. So there's two ways. If the borrower is responsive and they're cooperative and talking to you, you would ask the borrower to send you a copy of their insurance, and you would request that your name be added to the insurance. Once you have a copy of that, you could call the insurance company yourself and say, hey, we're the lenders, and we own the second mortgage or the first mortgage on this property. Please add our name to it. So they'll verify that. You have to provide proof, of course, that in terms of assignment of mortgage and everything. And once they verify the documents, they would add your name to the insurance. But there will be several cases where the borrower is not responsive and you have no idea if they actually have insurance on the property or not. So in that case, there's something called a forced placed insurance, lender's insurance, that you would place on the property. We do that for all of our loans. As soon as we purchase them, we go ahead and buy a forced placed lender's insurance on the property. And if the borrower is unable to provide proof of insurance within a certain period of time, this and also these charges do get added to the loan amount, not directly to the loan unpaid principal balance, but to the charges that are accrued over a period of time. So yeah, that's one of the ways that you could do it, and when you don't know if the borrower has insurance on it, and if you want to be protected.
Okay. We had, similar to that, someone had a question on how do you make sure taxes are being paid, like property taxes, so you don't have any tax lien sale on a property?
That's a good question. So every month, or I think we do that every quarter, depending on when we acquire the asset, we make sure we're regularly following their tax payments online on the county website. If we do see that the date is due soon, like say it's due in May and the borrower has still not made any payments, we go ahead and make that payment and add that to the charge in our servicer's account. If we and we also send reminders to the borrower saying that, hey, your tax is due. And then when we make our phone calls to them, we also mention that they need to have their taxes current in order for, if they don't have an escrow account with us, then they are responsible to pay the taxes. If they do have an escrow account, then the lender pays for it, and then they would add it to the charge on the loan. So we need to continuously track the taxes and make sure that somebody's paying for it. It's either us or the borrower who's paying for them.
All right, we got about 10 minutes left. I have one more question. I'll let you go to your next slides. Someone just wanted on this last example, basically. So there's $140,000 first. So the borrower was keeping the first mortgage current, was just defaulting on the second, or were they defaulting on both of them?
So that was interesting, actually. I think they were defaulting on the first, but that was only because they thought they were going to apply for bankruptcy. But as soon as they realized that that was not going to happen, they immediately and it was only a month, I think, that the first was in default. But again, since there was a lot of equity in the property, we were covered. Even if it did go through a foreclosure, even if the first mortgage did foreclose on the property, we would have been covered by this because of the amount of equity in the property itself. So yeah, that's a good question.
All right, well, Patty, go ahead and go on the next slides, and we have a couple more questions I'll just save to the end.
Okay, sounds good. So this is a beautiful home in Harbor Springs, Michigan. This is one of our more recent ones, actually. The borrower, let me go through the details first. So the first lien unpaid principal balance was $44,000, and also we had two and a half years of arrearages on it. The monthly payments were about $400. We purchased this note, and it was the first mortgage that we purchased on it. We purchased it for $24,500. The property itself was worth, as is, $60,000. And again, we try to consider the least possible fair market value for the property, the 30-day quick sale price. But if it comes to actually selling the property, we know that we could actually get higher amount, but we go with the least numbers just to make sure that we have enough cushion in there and we're not overinflating our numbers. But yeah, we purchased the FMV at the time was $60,000. Right now, the borrower was actually unable to reinstate the loan I think she tried several times, but she was unable to reinstate the loan. But we worked with her and we tried to analyze what her situation was, and we provided a creative solution for her and said, okay, why don't you pay us for 6 months? Why don't you make regular monthly payments of the same monthly P&I for $400, and then at the end of 6 months, based on your performance, we could either offer a loan modification, or she actually has a relative that she said could assume the loan for her. So at the end of 6 months, based on the performance, we would either offer the loan assumption or a loan modification option to her. And then at the end of 12 months of seasoning, after the loan modification, we'll be selling the loan to other investors for a 15% discount, which will bring up the total ROI. Actually, let's go over the numbers. So 6 months of payments would be at $400 a month, would be $2,400. And with the loan modification and loan assumption, the 12 months of seasoning would come up to $4,800. And once we sell this as a reperforming note at 15% discount, we'll be able to sell it for, say, $37,000, which brings us to a total incoming of $44,800. And the expenses so far for holding the note for the servicer, for our attorney to draft the forbearance agreements, the loan modification agreements, for our door knockers, for our realtors, all of those expenses come up to $3,000. And the ROI on this would be 70%. So this is actually a great one. I think we just received on April 10th, it was due on April 1st. So we received the first payment on the forbearance agreement this month on this. So this is one of the good examples that I'd like to throw out there, where the borrower was actually in a very bad situation, and I'm really glad that we were able to help her out through this. So yeah, we're in all of these case studies, we're trying to provide win-win situations for the bank, the investor, and the homeowners. And the way we work is we have joint ventures where we work with our joint venture partners, usually IRA investors. We have people using their trust funds, their IRA accounts, only because, and I might personally prefer IRA investors because your money is being multiplied within the IRA account almost in a tax-free situation. So in a joint venture with us, the investor would fund the asset purchase and the workout costs. So we would perform all of the due diligence. We would pick out the asset, and we would send you a document that would list out all the information saying that these are the numbers, these are the typical exit scenarios that we're looking into, these are the ROIs that we're expecting from these. And then you could either, and I know, Scott, you mentioned this in yours, so equity participation. So you could become an equity participant and, work on the risks and the investment with us, or you could be a preferred rate investor in the secured promissory note space. So Ada Financial would be handling the asset sourcing. We would do the workout management. We would talk to the borrowers. We would try to find solutions through them. And then at the end of the term of the joint venture, we would sell the asset to capture the investment gains, and then we would split the profits between the investor and us. Do you have any questions, Scott, or did you want to go ahead and do the other one?
Yeah, let me go ahead. I'm going to pull back just so I'll leave this up here for a minute. To get more information or get in touch with Patty directly, here's her information on this last slide. Again, info@aderfinancials.com, or by dialing 267-267-8255. 571-6119. One of the questions somebody had, we've been providing this presentation to the attendees. We're recording tonight's class. If you didn't jump on early at the very beginning, we are recording this webinar. We'll be able to send the playback link out to everyone as well. It'll also be up on our YouTube page probably tomorrow.
Yeah. So if you have any questions at all, feel free to call me or email me. Either way, I'm always available. So.
Okay.
Yeah. Go ahead.
Yeah, and as I mentioned, I'm going to go through just a very quick case study of someone looking to buy a mortgage loan, just how the process works from Advanta's perspective. And this obviously a little bit different maybe if you were doing something with ADR specifically, but for an individual who wants to invest in a mortgage loan using an old 401k, again, the terms that are set, if you're buying non-performing notes, obviously you as the IRA owner are going to determine what investment you wish to make. And kind of the roles of the parties involved, if you're the account holder, in this case, Paul, you're going to open up and fund your account with a rollover transfer, ultimately find a loan to make, and analyze the terms. So again, it's up to the client when they're investing with their IRA to determine whether or not this investment is suitable for them. That's not something Advanta does. It's something you as the IRA owner have to be comfortable with. Our job is to make sure that whatever it is that you're investing, and whether you're originating a new loan, you're buying an existing note, you're joint venturing with someone else, that whatever the paperwork is that documents the ownership for your IRA, we want to make sure that the IRA is properly listed. So we're involved from the very beginning in getting your account opened, getting money transferred tax-free or tax-deferred, and ultimately then making the investment properly reflected as the investment in your IRA and sending the money out of your IRA, and then going forward receiving all the income and depositing that back into your IRA, doing any reporting that's necessary to go along with that. So we try to make the process as simple as possible. Opening up your account takes only a few minutes. Funding account can take anywhere from a few days to a few weeks, depending on where the money is coming from. And ultimately, you're telling us what it is that you want to invest in. So I'd encourage anyone who's listening, if you're interested, you want to speak with myself about the IRAs, give me a call. We do free consultations on the IRA side. I'm sure Patty would be more than happy to talk with you as well at ADR if you have a question on that. And Patty, someone did ask if you can provide your contact information again. It was info@adrafinancials.com. And then what's the best number to reach you at?
Yes, so you could call me on 267-571-6119. And also, actually, if you could just email me your information, or if you could email Scott, he could forward your contact information to me, and then I can add you to my email list, and then you could get our information about our webinars or, joint ventures or anything else that you may be interested in. And we also provide active education to any new note investors. So any question at all, just feel free to call me, and then I'll be there to answer them.
Yeah, we did have a couple questions. I think these probably be better offline, Patty, but one of the questions somebody asked is, what laws apply when making a mortgage loan? I think that's a very broad question. I can tell you only on the IRA side of things, you definitely want to either have a mortgage broker or a lender involved or someone knowledgeable walking you through it, because there are a lot of rules and new laws out there as far as loaning money from any source as a private lender. So there are definitely going to be some laws that apply. Somebody else asked, what kind of yields typically does ADR offer to investors? Again, this was not meant. Today's webinar is not a advertisement or endorsement by Advanta necessarily of ADR. But if you want to contact ADR, I'm certainly, Patty, you'd be able to talk to them more about that off the webinar, correct?
Yes, absolutely, yes.
And then we did get one good question said, we're talking about the non-performing notes, and you have your exit strategies to either get them reperforming or maybe even sell them off from there. Someone asked, do you get stuck sometimes with no equity loans and owners that tricked banks just to live expense-free for a few years until they're foreclosed? And if you don't if that hasn't happened to you all, what do you do to make sure that doesn't happen?
Unfortunately, that does happen quite a lot. So yes, because these loans sometimes change hands so many times, the borrowers kind of get complacent. whenever they receive a foreclosure notice or a notice of default from a lawyer, they no longer think that that could actually happen. So one of the things that we try to stick by is to give them some strict dates, and we actually follow through. If we tell them that we're going to call them on so-and-so date, we make sure that we do call them on that date. And if they receive a notice of default saying that if they don't respond within the next 30 days, we make sure that after the 30-day period is over, they do get a letter from us saying what our next steps are going to be. So we make sure that we are continuously in contact with the borrower, even though we may not receive any response back from them. We make sure that we're always keeping track of it and making sure that the legal process is being followed and is being communicated with the borrower so they know what's going on. And usually that kind of brings them back into reality, and that kind of gives them that push that, we're actually serious about this. So they give us a call back and say, hey, we didn't know you were going to foreclose, so let's talk. So that's happened sometimes, yes.
All right. Well, we're right about the hour mark. So, Patty, I want to thank you very much for coming on tonight. We had some really good questions and some great interaction. If you want to, maybe give your phone number and email one more time for people to reach out to you.
Sure. Thank you, Scott, for having me here. You can reach me at 267-471. I'm sorry, I take that back. 267-571-6119. And my email address would be info@aiderfinancials.com. That's AIDER financials.com. But phone call or text message or either ways, you can be in touch, and I will give you a call back right away.
All right, great, Patty. Thank you very much. My contact information is here on the last screen. I'm Scott Maurer with Advanta IRA. I can help you any question you have on a self-directed IRA, or I did have one private question come into me. We can certainly also work with solo 401ks. So if you have any type of retirement account, IRAs, old 401ks, you have questions on, give me a call. I can let you know at least what your options may be when it comes to self-directed. So again, I want to thank Patty for coming tonight. I want to thank everybody who attended live. Like I said, this is being recorded, so we'll send out the recording link as well. And certainly touch base with us and reach out to us again. Have a good night, and certainly join us for another one of these educational webinars. All of our events are listed on our website at advantaira.com. Thank you.